maximizing earnings on your savings in the UK. That's what I'm going to talk about in this video, because I know personally a lot of people just keep their money at one place. They don't know how to grow their money beautifully by putting in different places. What are the different techniques out there, how to avoid tax and keep it minimum, what are the platforms out there. So I really want to talk about this because I have been in UK for 7 years now. I have seen a lot, I researched a lot, and I have literally placed my money across 10 to 12 different banks, digital banks, platforms, bonds. I've scattered my money. So I want to make sure you also understand how to maximize returns on your savings, and then what are the platforms out there, the tax implications and all those bits. So stay tuned to the end. I'll be walking through the best things out there and what I'm doing myself. So just for context, I have at least accounts in 10 different banks and different platforms, basically to maximize my interest income. Now I can understand a lot of people just don't want to do it because it just feels burdensome. You have accounts in Barclays, HSBC, NatWest, Lloyds, Santander, Monzo. It just gets too much. I understand that part, right? There's no, and I also struggle sometimes to manage. There are different ways to do it, but yes, that's the reality. But the benefits coming out of all those accounts and the savings and everything is quite fantastic and outweighs massively the admin of managing all these accounts. So what generally happens with most of people here is they keep two accounts in UK, one for the salary, which is more like a high street bank, HSBC, Lloyds, NatWest, etc., where they keep most of their money in terms of the salaries, and it just keeps growing. And then the second account is more like a digital account whereby people actually use that for their spending, like groceries, like travel, different things that people that they do in their day-to-day. So they want to make sure their main account is saved, that details are not out, like debit card details, account details, and the smaller account, the less money is out. That's the general practice. I used to do it, a lot of people I know do it, which is perfectly fair. Now the problem here is the accounts. If you think of a normal HSBC account or NatWest account, the interest on these accounts generally is around 2 to 3%, literally below to the benchmark rate of interest for the Bank of England, or maybe slightly above. So even if you have like £50,000 saved with them, they don't give you a lot of interest on that. It's minimal. Now a lot of people come here from abroad, for example Pakistan. I say we see interest of 10, 15, 18% as well, and thinking here, oh, it's just 2% interest, 3% interest doesn't look good, and you feel like, oh, your money is not making anything. Unless you're investing, of course, and it's being eroded by inflation as well. So that's generally what a lot of people do, because they don't know what to do, or they just feel like there's a lot of admin built into that. Now I used to do that, then I changed the strategy. Now I'll walk you through what different options are out there and how do you make sure you maximize your savings and everything. So first thing first, cash ISAs and stocks ISAs. Now there's a lot of debate going on around cash ISA, and they have actually reduced the cash ISA amount to 12,000 in future, and even they want to tax cash in stocks ISA. But overall, this was a bracket. If you have been having cash ISAs in the past, you would have saved a lot of money without any tax. So those ISAs are supposed to be tax haven for you, no tax implications on any actual amount as well as any income that you earn on them. And generally there are a lot of providers like Trading212, Plum, Moneybox. They give you an average of 4.5, 4.6, 4.7 interest on those cash ISAs, and there are a lot of other options as well. So quite a decent amount, your money is saved, and then you don't need to worry about any tax implications. Thinking further about ISAs are generally either fixed rate ISAs, which provide high interest rates, of course, or more like a limited access ISAs or easy access. So of course, as stringent the terms are, the fixed rate is, it's going to be having more interest versus an ISA which is flexible, where you can deposit anytime or withdraw. Then it will be having less interest, but again, generally a good option if you got a lot of money to save and then you want to put in tax-free structure. So that's the first thing. Now secondly, about the mainstream banks and digital banks. Now I know there are a lot of banks out there, each of them have their own pros and cons. Over the time I had a relationship with Barclays, Santander, NatWest, and then I had a relationship with HSBC, I worked with Monzo, Revolut, Starling, Chase, and many more. I know a lot of them have a regular saver sort of account whereby you will be given 6%, 7%, maybe 7.5 or 8% interest on limited amounts. Take an example of HSBC, they do 5% on the regular saver. Take an example of NatWest, they have the regular saver at around 6%. Take Take an example of Zopa Bank, which is a digital bank. They got a regular saver of 7.1%. Talk about Chase for new customers give you 5% for on the saving account almost. So most of these companies or the banks have some sort of account whereby they'll be giving you a lot more money than the original interest. So general strategy, what I have done over time is, oh, okay, I can get into all the accounts. Accounts are free as long as I can get them, and then I open those saving accounts with them and then save my money there, and my money keeps growing and growing and growing with 6, 7, 8% as the interests are there. Now the problem here comes in then, then what will happen if you are saving amounts, the actual interest income crosses the threshold of £500 or £1,000, £500 for people who are in the higher tax bracket, like 40% above, and then £1,000 saving allowance for people who are in 20% tax threshold. So take an example of myself in the 40% tax threshold. If I am earning more than £500 on my saving accounts, then for any remaining income I'll be taxed at 40%. Again, defeats the purpose, because after 500, if I'm earning £100, government is taking my £40, doesn't make any difference. So that's where the earlier interplay with the ISA also comes into play, because in the ISA you are not taxed any money at all, whereas in your accounts you will be taxed money. So you play smartly. By way of smartly, I mean that in the current year you don't have an ISA allowance, you can open a fixed rate saver account, and until the account matures your interest won't be counted. So there are different ways to do it. You can do the easy access account, you can do maximum interest accounts, you can do fixed terms account, you can do all the sorts of things. Sometimes you can even do 2 to 3 years fixed term accounts as well, in which after 3 years all the interest will be counted. So all the options out there. The point really is all the digital banks as well as physical banks have some sort of accounts, and you can literally open as many accounts as you like, as long as your employer doesn't have any restrictions. So that's the second part of it, whereby you can earn a lot more interest. The other important bit is government bonds. So there's the institute ns&i, whereby you can buy government bonds. There are a lot of government bonds out there in terms of growth, and then they provide you fixed interest that's tax free as well. So if you got a lot of money which you've already put in your ISA, and then you know you are going to be breaching that £500 limit on saving allowance, then the next best option is literally the government bonds, unless you are of course investing in stocks. So government bonds, no tax implications. You can buy them online on the government website. Very safe, and then they are backed by government guarantees, and interest rates are not like the maximum in the industry, but they are not bad as well. And you can definitely find all the guidance on Google. Just type NSI bonds. Again, decent. The fourth important thing then is, I know a lot of people are again worried about, too many accounts, how do I manage, how do I make sure everything's intact and there are no issues going on. There are some platforms out there. Take an example of Reason. Now that platform has a lot of banks. It's a sort of an aggregator platform whereby they provide you offers from all the banks literally there, like whatever the banks enrolled in there, and then you can open your account there in the system and not need to walk through all the banks separately. So again, those platforms are out there. Again, how safe they are, I don't know. They are like not 100% safe as the banks directly, because banks has this FSCS protection of £120,000. Those platforms also have the protection, but they don't work exactly in the same way. So, but again, that's another option where you can have multiple accounts in one place. You don't need to go through all the banks separately. I think the purpose of saying all this is, it's not like nobody's smart, everybody wants to save a lot of money, but the thing is there's so much out there where you may not understand what's the right thing to do and what's the best thing to do for me in terms of saving my money and keeping it safe. I can understand completely, just gets too much sometimes when you have to manage 8-10 accounts at the same time. It gets difficult, but if you manage it smartly, you have your tracker and everything, you know what you're doing, it makes a lot more money, because you will be looking at, generally, I did my calculation of last year. If generally I'll be getting an interest of 2 to 2.5% in a mainstream bank, putting my all money there, on average I got an interest rate of around 4.8% over last year, almost more than double, by putting through regular savers, platforms, ISAs, and every single thing together. So that can be good money out there, and hopefully I think you should be able to work through that. The only last thing I would say is, if your partner is not working, then of course they have a lot more allowance, and if it's a combined money joint accounts, or if the money is with the partner, if they are not working, they got whole 12,000 plus allowance to spare for the whole interest income. So again, no issues there. If you don't want to keep in the ISAs or this other places, you can keep earning in the normal saving accounts. So that's literally what I do. Again, a lot of banks have different perks. That's a separate story. But just think of the saving accounts and the interest rates. I think just works out wonderfully and beautifully, and you can earn a lot more money via the interest. Thank you so much for watching.